Hey, cash flow maximizers. Today we're going to talk about first position and second position HELOCs, home equity lines of credit. It happens to be our favorite debt weapon when it comes to doing dynamic banking, also known as velocity banking. So stick around and we'll go over the differences between the two and why I prefer one over the other, or where your situation may benefit more from one over the other.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So jumping right into it, let's first look at what is a first position and a second position home equity line of credit. What does that mean? Whether a home equity line of credit is in a first position or a second position just depends on if there is already an underlying mortgage. So if there's no mortgage currently on your property and you get a home equity line of credit, you suddenly have a first position home equity line of credit. And if you do currently have a mortgage on your property, you can get a second position home equity line of credit, which just means in the event of a foreclosure or a sale, the main mortgage, which is in the first position, the main mortgage in the first position gets paid off first. The home equity line of credit gets paid off second. And you can actually get loans and other things in third position, fourth position, fifth position. Loans and liens against your property will end up being in those positions. What you won't find is you won't find a bank typically that will lend you for a mortgage or a home equity line of credit that will be in anything except for the first and the second position. So what is the main differences? Well, when we think about a first position home equity line of credit, there's really two products out there. One is your all-in-one mortgage, and one is just your basic home equity line of credit that can either sit in first or second position. So the all-in-one mortgage, there's one company out there I'm aware of that does it in the United States. These are more popular in other countries. So this one company that does it, you still have all of the fees that are associated with a regular mortgage, except they're going to lend you a full mortgage type amount against your property, and you'll be able to access it just like a home equity line of credit. So they call those the all-in-one mortgages. They're pretty hard to find because, like I said, there's only one company I'm aware of in the US that does those currently, and it doesn't really save you on fees. It can also take a while. So I know somebody who had recently got one, and it took them like 6 months to make that happen. For whatever reason, I don't know what that company goes through to make it happen because I haven't used them before, but it can be complicated. So it's a good product, what you end up with, as far as being able to put all of your money towards paying down that mortgage. So if that's your goal, you might check it out. It might be worth it for you. But the downside is that it is a little higher interest rate than you would normally see from a mortgage. And this is essentially what boils down to the main differences between the first and the second position HELOC, which is what I wanted to bring up. Now, the other option for the first position is the HELOC, just your standard HELOC. Now, we love HELOCs because they don't come with a lot of fees. In fact, they may come with zero fees. The home equity line of credit that I have came with zero fees. I didn't pay an appraisal fee, and I didn't have to pay any type of lending fees. It was really quick and easy to set up, just took a couple of weeks, and I was good to go. So when we're considering first and second position, if you don't have any liens on your property or your first mortgage is fairly low, home equity lines of credit are typically available for $100,000 to $150,000. Some companies may extend more than that, but usually there's a limit there. The rates tend to be higher than your regular 30-year fixed mortgage, and it's these things that factor into what is going to make for a better choice, depending on your situation. In the first position, if you have a house that's worth $300,000 and you want to access that equity, You may not want to go with a first position home equity line of credit if you would like to get more than $100,000 to $150,000. At the same time, if you are looking for $100,000 to $150,000, you may not want to use all of that on a home equity line of credit, especially in the first position, because that is giving you a high interest rate for a balance that you're likely not going to pay down for a number of years, and you're going to be left with a bunch of equity that you're unable to get to. So it's my preference to go with a second position home equity line of credit, because your first position mortgage is right now at close to, if not historic lows. So having a 30-year fixed mortgage at 4% or lower is incredible. It's a great way to access the equity that's locked up in your home. And you can get that up to 80% of the value of your home without having to get any private mortgage insurance. So if you can access 80% of your equity in a 30-year fixed, that's great. But we also would like to have a debt weapon, something that we can use to pay it down quicker or to pay other bills down quicker. So that's when we look at, are there banks that will loan more than 80% of the value? Yes, there are. The home equity line of credit that I got, I was able to tap 90% of my equity. That same bank will offer 100%. They're slightly different loan programs, and so the interest rate goes up if you're accessing a little bit higher amount. But because I have 80% or less in my first mortgage, I think I'm at 60% or so now. If we have that major portion of our mortgage on a very low interest rate product, I almost don't care what the interest rate is on my home equity line of credit because of how we are going to use it to pay down all the other debts that we have or to fund our infinite banking policy. So if I can get 3.5% on my first position mortgage, I can go with a 6% or a 5% on my home equity line of credit, and I would be thrilled with that. It actually works out just fine. Now, we always want to get lower interest. The lower the interest, the better. But sometimes we're not very picky. And this is one of the times where I'm not very picky because we're going to be funneling all of our income through it, doing dynamic banking, and we're going to be offsetting those interest charges, right? And basically, if we do the math on this, it's going to show that we end up paying a lower amount of interest overall using a second position line of credit and a lower interest first mortgage than we will if we just use a first position HELOC for the full same amount of balance. So I wasn't planning on getting into the specific numbers in this video, but I'll probably do another video for that at some point in the near future so that you can see the numbers laid out. But I wanted to get this discussion started because I'm sure some of you folks out there are looking into this and you may have these same questions that I had. So I hope this helps answer your question. So if you found value in today's video, be sure to hit the like button and subscribe so you can follow along, and we'll see you next time.